Happy Sunday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. This is an extra Sunday episode. There is so much to cover, so many important developments to cover that we're putting this extra one out today. So we're on top of everything as we move into what will no doubt be a very busy week from tomorrow. So with that said, let's jump in. And first up, we need to start in North America. The US economy faced a double blow on Friday as Moody's ratings downgraded the country's sovereign credit rating, and new data revealed consumer sentiment has plunged to near record lows. Together, these announcements have deepened anxieties over America's fiscal health and economic trajectory. Moody's downgraded the US long-term credit rating by one notch from AAA to AA1, stripping the country of its final top-tier assessment among the three major rating agencies. The move puts Moody's in line with Fitch and S&P Global Ratings, both of which had previously lowered their ratings amid mounting concerns over ballooning deficits, political dysfunction, they argue, and a rapidly growing debt burden that now approaches $37 trillion. Quote, while we recognize the US's significant economic and financial strengths, we believe these no longer fully counterbalance the decline in fiscal metrics, end quote, Moody's said in a statement, citing successive administrations and Congress for chronic overspending and lack of corrective action. The downgrade triggered an immediate response from financial markets. Yields on 10-year US Treasury notes jumped to 4.49%, and futures tied to the S&P 500 slipped in after hours trading. Investors fear the downgrade could push up government borrowing costs, just as Washington prepares for potentially even higher deficits due to expanding entitlement costs and tax legislation. At the same time, the University of Michigan's latest survey revealed that U.S. consumer sentiment fell to its second lowest level on record in early May, dropping from 50.8 from 52.2 a month earlier. Inflation expectations, meanwhile, surged to multi-decade highs. Respondents expect prices to rise 7.3% over the next year, the most pessimistic view since 1981. Long-run inflation expectations hit 4.6%, the highest since 1991. The collapse in consumer confidence has been fueled by concerns over the ongoing US-China trade war and the wider global trade reset, with nearly 75% of survey participants spontaneously mentioning tariffs cutting across partisan lines, even as US President Donald Trump's administration announced a temporary easing of trade tensions with Beijing. The University of Michigan survey director noted that, quote, temporary pauses are unlikely to convince consumers that trade policy has stabilized enough for consumers or businesses to plan effectively for the future, end quote. The timing of Moody's decision, which came as Congress debates a tax and spending package, has raised some eyebrows. The legislation seeks to extend key provisions of the 2017 Tax Cuts and Jobs Act and could add $3.8 trillion to the federal deficit over the next decade, according to the Joint Committee on Taxation. Some conservatives have already blocked its progress, citing cost concerns. Quote, the downgrade may indicate that investors will demand higher yields on treasuries, end quote, warned Tracy Chen, a portfolio manager at Brandywine Global Investment Management, adding, quote, it remains to be seen whether the market reacts differently, as the haven nature of Treasury and the US dollar might be somewhat uncertain, end quote. The Congressional Budget Office, CBO, has warned that the U.S. debt held by the public is on pace to reach 107% of GDP by 2029, surpassing levels seen at the end of World War II. That forecast doesn't account for potential future spending increases or tax cuts either, and Moody's now expects the federal deficit to widen to nearly 9% of GDP by 2035. An incredible height, driven by rising interest payments, aging-related entitlement spending, and relatively low tax revenues. Despite the dire warnings, some economists question the rationale behind the downgrade. Joseph Livornia, a former Trump White House official and now chief U.S. economist at SMBC Nikko Securities, called the timing, quote, very strange, end quote. He argued that America remains the most productive large economy and the fastest growing among industrialized nations, adding that 100% debt to GDP ratio is, quote, not unusual, end quote, globally. And indeed, Indeed, many economies, large and small, do have much higher debt to GDP ratios. As we discussed on my other channel, China Update, yesterday, China's total social financing, or total debt in its system, reached almost 310% of GDP last month. Still, Moody's emphasized that higher Treasury yields and, quote, political dysfunction, end quote, are undermining US fiscal sustainability. The agency had signaled its concern last November when it revised the US rating outlook to negative. That warning has now materialized into a formal downgrade. The collapse in consumer sentiment only adds to the bleak outlook. The Michigan survey showed sharp declines in both the expectations and current condition indices, with consumers' views of their personal finances hitting the lowest level since 2009, the global financial crisis. Financial expectations fell to a record low as well. The pessimism has yet to show fully in consumer spending, however, with the gauge of buying conditions for large items improving slightly. However, fewer respondents said they would continue to spend normally if prices rise further, a sign that inflation fatigue may soon translate into reduced demand. The US economy appears to be navigating uncharted territory, with deteriorating creditworthiness, high inflation expectations, and consumer angst threatening to undermine its post-pandemic recovery. As global investors digest the implications of Friday's developments, pressures will mount on lawmakers and the White House to take credible steps to address the nation's growing fiscal imbalances. Whether they ultimately succeed or not, of course, remains to be seen. Until then, confidence both at home and abroad may remain in short supply. We'll be following this story as well as the other major stories around the world as we enter this new period of change and transformation here on Market Update every day. If you want to be on top of these developments, consider subscribing to Market Update, hit the bell notification icon, and you will be. If you're getting some value from today's episode, don't forget to hit the like button. Let's continue. We now move across the Atlantic to Europe. Italy is emerging as a major winner in Europe's evolving wealth migration, drawing affluent former UK residents disenchanted by the end of the UK's non-domiciled tax regime. Known informally as Empty London, Italy's strategy is proving effective, with a stream of hedge fund managers, ex-CEOs and billionaires now settling in Milan. The UK's recent scrapping of non-dom tax breaks, including inheritance benefits for overseas trusts, has triggered a dramatic exodus. Italy, by contrast, offers an attractive flat tax of €200,000 on foreign income, lenient inheritance levies, and a vibrant urban lifestyle, especially in Milan, which is quickly building on its post-Brexit rise as a financial hub. Quote, "There's a snowball effect," end quote, said wealth advisor Mark Arkeson, adding, quote, "This is going to have seismic repercussions," end quote. Experts warn the UK could suffer long-term damage, with 75,000 non-doms contributing over £8 billion annually. The Adam Smith Institute estimates a potential £111 billion economic hit and 40,000 job losses over the next decade if the exodus continues. Quote, "London will suffer," end quote, said Gary Lindersberg, former owner of Mayfair's Arts Club, speaking to UK-based Reuters, adding, quote, "Italy took the best parts of the UK's old system and made them easier to use. People and their capital are moving fast," end quote. And finally for today, we move to Asia. Japan is holding off finalizing a trade agreement with the United States as Prime Minister Shigeru Ishiba faces mounting domestic pressure to resist a deal that fails to fully eliminate the 25% US tariff on Japanese car imports. The Trump administration has made clear it intends to revise global tariff arrangements in the coming weeks, but Tokyo is recalibrating its stance, fearing a political backlash ahead of July's upper house elections. The automotive sector, Japan's largest export industry to the US, is at the heart of the dispute. Industry analysts estimate that the Trump tariffs could shave up to 2 trillion yen, $13.7 billion from the annual operating profits of Japan's leading car makers. At the same time, the Prime Minister has pledged to shield the domestic agriculture industry, a sector critical to the ruling Liberal Democratic Party's rural base. While Japan remains one of the US's closest allies in Asia and largest foreign investors, Tokyo's leverage is limited. Quote, Ishiba can't afford to antagonize the White House, but neither can he afford to be seen as caving to Trump's demands, end quote, one Japanese official noted. Negotiators now expect no breakthrough before the July vote. Meanwhile, the US president is pursuing parallel tracks of tariff talks with several major countries, including India. And in an interview with Fox News over the weekend, Trump claimed that New Delhi had offered to eliminate all tariffs on American goods, expressing, quote, they're willing to cut 100% of their tariffs for the United States, end quote, he said, though he also signaled no urgency in sealing a deal, adding, quote, that'll come soon, I'm in no rush. End quote. Trump added that the US would not strike deals with every country, hinting at a strategy of selective engagement. Quote, everybody wants to make a deal with us, end quote, he said, adding, quote, I'm using trade to settle scores and make peace, end quote. India's case underscores a broader US strategy that mixes negotiations with unilateral tariff actions. Trump said his administration would announce new import duty rates for a number of countries, quote, over the next 2 to 3 weeks, end quote, acknowledging that staffing constraints limit the ability to negotiate with all partners simultaneously. The president also pointed to recent tariff reductions with China as a model, describing the rollback of punitive duties from 145% to 30% on Chinese goods and from 125% to 10% on US exports as an act of generosity. Quote, if I didn't do that deal with China, I think China would have broken apart, end quote, he said. With July's tariff pause looming, key US trading partners are now weighing how far they can go to appease Trump without inflaming tensions at home. Okay, that is today's special extra Sunday episode of Market Update. I hope you got some value from it. Thank you so much for watching. Have a good, restful weekend, and I will see you for a new week of updates tomorrow.